Imagine walking into your bank branch and depositing just $1. The teller barely looks up. Now imagine walking in and depositing $1 million. Within minutes, you're sitting in a private room sipping complimentary coffee, and the branch manager personally comes out to shake your hand. Same currency, same bank. So why is the treatment so completely different? In this video, we're going to break down exactly what happens behind the scenes the moment you deposit money into a bank, and how that bank you trust as a safe place is actually using your money to make money for itself. By the end of this video, you'll never look at your bank account the same way again. Let's get into it. When an average person deposits $1 or even $100 to the bank, it's just a number that gets locked into the system. No special treatment, no separate department, just a standard automated process that takes a teller 2 minutes. But the real story begins with what happens to that money behind the scenes. The moment you deposit $1, that money technically stops being yours in the way you think. It becomes a liability on the bank's books, and you become a creditor to the bank. In other words, you've essentially loaned the bank your money, and they can use it however they want until you ask for it back. The same rule applies whether you deposit $1 or $1 million. The difference is scale. When a bank receives a huge sum like $1 million, it's not just a deposit anymore. It's an opportunity. Fuel for loans, fuel for investments, fuel for profit. That's exactly why banks treat small deposits as a maintenance cost and large deposits as growth fuel. Let's compare both scenarios side by side. If you deposit $1, you get a standard savings account. Your interest rate sits at the lowest tier, sometimes as low as 0.01%, basically nothing. No dedicated relationship manager. You're in the general customer service queue like everyone else. If something goes wrong, you're the one chasing the bank to fix it. If you deposit $1 million, you're immediately moved into the bank's private banking or wealth management division. You get a dedicated relationship manager who personally takes your calls. Interest rates become negotiable, often significantly better than the standard rate. Loan approvals become fast and easy because the bank already knows you have collateral. You get access to exclusive investment products the general public never even sees, private equity deals, premium mutual funds, structured products. Annual fees get waived, and your credit limits are dramatically higher. Here's the key thing to understand. This differential treatment is built directly into the bank's business model. A bank's real profit comes from loans and investments, and the bigger the deposit, the bigger the leverage the bank has to create new loans. That's why banks pour their best resources into the customers who generate the most value for them. Now, we get to the most important concept most people never learn: fractional reserve banking. When you deposit $1 million, the bank doesn't lock that entire amount away in a vault. Under regulatory requirements, the bank only has to keep a small percentage, called the reserve ratio, and is free to lend out the rest. Let's say the reserve ratio is 10%. That means out of your $1 million, the bank only keeps $100,000 on hand and lends out the remaining $900,000 to someone else, maybe a small business loan, a mortgage, or a car loan. When that $900,000 gets deposited into another bank, the exact same cycle starts all over again. This is how your original $1 million effectively multiplies through the economy and fuels enormous banking activity. The entire system runs on the assumption that not everyone will demand their money back at the same time. This is exactly why banks value large deposits so highly. It's the fuel for their loan-making machine. A $1 deposit simply doesn't contribute much to that machine compared to $1 million. There's another important angle most people overlook: deposit insurance limits. In most countries, deposit insurance, like the FDIC in the US, only covers deposits up to a certain limit. If the bank fails, the government or regulatory body only guarantees your money up to that fixed amount. If you have $1 in the bank, it's fully protected, no risk at all. But if you have $1 million deposited and the insurance limit is, say, $250,000, the remaining $750,000 is technically at risk if that bank collapses. This is exactly why high net worth individuals spread their money across multiple banks to stay within the insured limit at each one. It's a simple but powerful financial strategy that most people simply don't know about. So, how can you actually use all of this to your own advantage? Don't keep all your money in one place. As your balance grows, consider spreading it across multiple banks to stay within insurance limits. Learn to negotiate. If your balance is growing, don't be afraid to ask your bank for a better interest rate or fee waivers. Banks want to retain high-value customers. Don't just let your money sit in a savings account. The bank is using your money to lend out and profit from. You should be putting your money to work too, through investments, index funds, or high-yield accounts. Take advantage of relationship banking. As your net worth grows, it becomes easier to negotiate better deals with your bank. This is standard business practice, so use it. The truth is, a bank isn't some neutral, safe space where your money just sits. It's a business that profits from your money. The more you understand the system, the better you can position yourself to grow your own wealth within it. So, next time you walk into your bank branch, remember that smile, that "right this way, sir," that free coffee, none of it is random. It's a calculated business strategy. The bank knows exactly how much value your money brings them and treats you accordingly. If you found this video useful, drop a like and let me know in the comments if you'd want me to cover how banks actually approve loans or how your credit score really works behind the scenes next. Don't forget to subscribe, because we'll keep breaking down the hidden financial systems they never teach you in school. See you in the next video. Until then, know where your money really goes.